Barclays is taking a big step to expand its coverage into the footwear apparel space. The firm out with a note, initiating 4 footwear stocks: Crocs, Skechers, Deckers Outdoor, and On Holding, with each stock receiving an overweight rating. Here with us now is the author of that note, Adrienne Yih. She's managing director and consumer discretionary analyst at Barclays. Adrienne, it's wonderful to have you here with us. I guess, you've got 4 stocks here. Let's start with Crocs. Why are you so compelled when you look at a name like Crocs? I think so many of us look at them as a fashion fad that surprisingly has not faded.
Yes. What I'd say about the 4 names that we initiated on, I would say that the footwear space is unique in that it allows for a lot of white space. So if you have a compelling brand and you have loyalty across, for different income brackets and different demographics, you can actually continue to succeed. I think what we like about Crocs is they command, literally the highest product margins, as one can imagine, right? 70% versus the sector sort of 50, 60%. And then in terms of operating margins, once they get that leverage on the model, they are printing, north of 25% operating margins, which is far and away like 1,000 basis points, 10 points above others.
Yeah, and when it comes to some of these names, obviously they operate in slightly different subsectors, but obviously Nike has been just this mega brand for so many years. We know they have their individual stumbles. Are any of these names also partial beneficiaries of Nike sort of working out its own problems?
So you hit the nail on the head. If we look at the horizon from 2016 to 2022, globally, Nike and as well as Adidas have given up, 4% from Nike and about 3.5% from Adidas. And so that opens up a ton of oxygen in the room for these nascent brands, like a Hoka and like an On Running, as well as a bunch of other running specialty, sneaker brands. And so what we've heard from Nike, self-admittedly, is that they really didn't do a good job in closing the door over the past 2 to 3 years and blocking out some of these innovative competitors. And I think we also heard on the last call from Nike that it's going to take some time for them to retrench, right? So they're doing franchise management and they're going to hold back on selling, certain of their products into the market. Again, it takes about 15 months to 2 years to build this innovation pipeline back. And it's going to leave some room for Hoka and for On.
I wonder, I think of these brands, and I mean this in a non-pejorative way, whether it's Hoka or whether it's Crocs or whether it's Uggs or even Skechers, maybe even On, as niche-y. They're a little fun. They're niche-y. And maybe their future is in not trying to take on Nike, because who can? Am I barking up the right tree there that if they play their niche really well, if their niche can mean rich?
Yes. So Tyler, I think you are spot on with the notion that each of these has a technology, a loyal following, a brand differentiator that at their size, right, can last them for years on the come. We like to think about kind of these brands as the S-curve of adoption. And we always like these brands are their best and strongest when they go from late early adoption to early mass adoption. That runway that has low brand awareness and high brand desirability can propel these brands for years. And we used to see this kind of back in the early 2000s, where you would see 3, 5, 7-year runs on these great brands. So I think you are absolutely correct. These guys need to stick to their technology and kind of play their own game in an area where they're still the smaller competitors, and they could double in size pretty easily with, not a lot of, harm, in terms of kind of taking a ton of share from the incumbents.